Have at it.
Well, good afternoon and welcome to our HighRock weekly client webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we try to talk about what we see developing in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of HighRock, our certified financial planning professional and wealth forecast specialist. Bianca Tomlinson is back, and she's balancing motherhood and our clients' needs. And each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this. And all you need to do is visit the homepage of our website and click on the Introduction to HighRock Private Client button. We do have a new look to our website. If you want to have a peek, let us know what you think. As you all know, our priority is to manage risk first and foremost, and currently we believe that we are in a time where investing risk is high and rising. We want to make sure that despite this, our clients have no trouble sleeping at night. So we are closely monitoring developments in the current investing climate and considering all the many risks that are in play. It is extremely important to us that you understand the risk level in your portfolio and how we are taking measures to protect you. If you wish to discuss risk in your specific portfolio in more detail, please do not hesitate to get in touch with us. Well, risk is elevated now because central bank balance sheets are at record levels from all the bond buying that they have done to create liquidity in the market since the financial crisis began. And as they reduce those balance sheets, less liquidity will likely increase the potential for greater amounts of volatility. Now, volatility has been held in check by years of central bank easy money and financial market liquidity. Starting next month, though, the U.S. Federal Reserve will begin to unwind some of that liquidity by not repurchasing maturing bonds that were previously on its balance sheet. And, Paul, do you agree that that could certainly be the beginning of higher levels of volatility?
Yeah, it sure could be. I think it's been so well telegraphed, though, that nobody seems to care. And, there were articles across the weekend about, how boring this is going to be, this balance sheet unwind from the Fed. So, and it's probably why volatility is still so low, I guess, until we see it. Maybe it's a show me thing.
I imagine it's a show me, feel me thing, because if I'm not feeling or reading it right, I sense a great deal of complacency out there at this particular moment in time, and that's because I think markets have become used to central banks bailing them out in times of higher levels of volatility. So it's going to be interesting, I guess.
Yep.
We also believe that all of this excess liquidity in the system has made the historical stock and bond correlations less reliable and potentially made traditional balanced buy and hold portfolios subject to considerably more risk, both in the United States and in Canada. Paul, anything you want to point out on the correlations? Doesn't seem that a lot has changed since last week, though.
No, it's still, quite frankly, correlations are moving in the right pattern that we would want to see to enable or have bonds provide flight to quality, flight to safety if there is a very negative event or risk off type period. So the past couple of weeks it's been that way, and it continues to move higher, as you can see in the bottom part of the chart in the far right. That green shaded area continues to kind of creep a little bit higher, which is what we want to see. Now, having said that, obviously stocks have gone up, bond yields have gone up, and bond prices have gone down. So that does hurt part of the portfolio for sure, but at least we know that's the proper correlation if there is a negative event.
And of course, the other risk that has been we've noted for the last number of weeks, I guess, is the strength of the Canadian dollar, which is better by some 10% versus the U.S. dollar since back in April, May. And I think it highlights the need to understand all of the risks that are at work here, and certainly foreign exchange risk is one of those. In fact, despite record highs for the S&P 500, in Canadian dollar terms, it is only better by about 2.5%, with Canadian equities up only marginally, and you've got Canadian bond returns negative by about 2%. It certainly hasn't been producing a great deal of growth for balanced and globally diversified strategies, right?
Absolutely. It's been tricky, been very tricky, and that currency is volatile. Well, volatile one way. It's really hurt performance.
And having a more tactical approach to investing allows us to not have to depend necessarily on the now less reliable old correlations, which do not appear to be mitigating risk for balanced portfolios as well as they have done historically. So we can, with our tactical approach, manage risk more effectively. Well, the Trudeau government, as we mentioned in our last week, has begun the process of bringing in new tax measures. So for our clients, we are keeping a very close watch on how these changes may impact you, and we will be happy to dialogue with you on what we think would be the most appropriate strategy to follow. Now, we are not accountants, however, and strongly recommend that you include your accounting professional in any discussions with us on investment strategy. So we are always happy to have and to sit down with you and your accounting professionals to make sure that we're taking the right path that makes sense for your particular situations.
Hey, Scott, I would just add on that topic, if any clients or prospective clients want to engage with us and talk about it, we are business owners, you and I, and these tax changes affect us. So we're pretty involved in doing some research on it and talking to other business owners and people that it will affect. And I'd say we have our ear to the track on this. So if there are any business owners out there, doctors, dentists, farmers, anybody that would be interested in talking to us, they should contact us on the side.
And the Ontario Securities Commission said yesterday that a survey it commissioned found that about 45% of pre-retired homeowners in the province of Ontario are relying on the value of their property increasing to fund their retirement. Tyler Fleming, the director of the investor office at the OSC, said that owning a home is not a substitute for retirement planning, and that homeowners without any retirement savings or plan are among those most likely to be counting on the value of their home appreciating. For all our friends and clients, we know that everyone needs a plan, and that is why it is always the first phase of creating an investment strategy for HIROC and HIROC clients. Well, June, at the end of the second quarter, the average Canadian household had an estimated net worth of about $723,000, and $274,000 of that was in home equity. And that basically means that 38% of Canadians' net worth is tied to their particular home. So that's just an interesting statistic. But in that same study that was done by the Dominion Bond Rating Service, they assumed 20% and 40% market value declines in properties, and the Canadian equity ratios decreased significantly with those. And Paul, you're mentioning to me earlier today that we've already seen a 20% decline in Toronto.
Yeah, and most other regions, certainly from Toronto Real Estate Board data, the market had peaked in April. And I really look at monthly data for the city of Toronto, and if anybody wants to talk about that, they can, or refer them to my blog. I think I wrote a 4-part blog in late June, early July. But and I've tried to update it each month for July, August, and I will. September's numbers will come out probably late next week. But August, I can tell you, in the city of Toronto, for those that care, semi-detached houses and condo apartments, technically, those actually increased in average sales price in the city of Toronto, city proper, not the GTA. Detached continued to drop down. So we do have a close eye on the housing market, and we could probably add, Scott, on this topic that the housing market in Canada is 23% of our economy on a direct and indirect basis. So again, this really does matter to us in our investment theses, including the Canadian dollar and what the Bank of Canada may or may not do on a go-forward basis.
Yeah, we'll talk about the Bank of Canada in just a second on that note. And of course, we remind you all that historical returns are no guarantee of future returns. But as you know, at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. And we also remind all of our clients that we are diligently working toward achieving your very specific long-term goals as set out in your wealth forecasts. These goals are intended to be achieved over a longer time horizon than those we might achieve in a single year. If you do wish to review your wealth forecast and any part of your strategy, we are always available to do so. So just reach out. You all know our key themes for 2017. No point in me having to reiterate those, but of course we are following the inflation story closely because it is an important theme. It has been perplexing, not only for us, but also for central banks on a global scale. As they try to determine how best to move forward. In the old way of thinking, if economies are growing, inflation should also be growing, but we don't, at this moment, see that inflation growing. So, except for the Bank of England or in the UK, all of the central bank targets are all inflation in the developed world are below inflation targets. So, it's something we're monitoring. When of course that's quite significant. Let's talk about the Canadian situation. Canadian inflation continues to underperform as of the data that was released on Friday for August. Interestingly, household furnishings and clothing are cheaper than they were a full year ago. And the Bank of Canada's core inflation data remain below target. So, Paul, let's talk a little bit about the Bank of Canada. They've raised the bank rate twice now, up 50 basis points. Inflation still, and even at the core level, inflation well below target. What do you think?
Well, yeah, this is kind of interesting. I mean, it's ticked up the last few months here, but it's still only at 1.5, and their target is at 2. So, as you can see in red, I don't know. I think, Scott, that they really just took back. They raised rates twice over a 2-month period, or just under. I think really to take back the rate cuts that they put in place in 2015. When oil was getting annihilated and clearly was going to hammer our economy. So I think they just took those back. There's been some talk from bank officials. Deputy Governor Lane spoke late last week, and mentioned that they're going to keep a close eye on the currency. I think they're a little bit concerned about that 10% appreciation in the currency over a 3-month period, because it does tighten up monetary conditions, especially through our exporters into the U.S. makes our goods more expensive. So I don't know. I don't think they're going to really go again. Now, having said that, maybe we want to talk a little bit about Fed Chair, the U.S. Central Bank Fed Chair Yellen spoke again today. And, all these central bankers, Scott, are going on and on about inflation's transitory, or lack of inflation is transitory, and it'll come back, and we've got to get ahead of the inflation curve and start raising rates. We can't be too gradual. It's all kind of on the come that inflation is going to resurrect here at some point. And it really hasn't for, 10 years. And if you look even longer, we could put a chart up next week maybe on, a 30-year chart on inflation versus U.S. 10-year treasuries. And it's gone down. Inflation goes down, U.S. Treasury yield goes down, price goes up. So I still am not overly concerned about inflation personally.
Well, here's the interesting thing. We always tell our listeners that bond markets do tend to lead because bond markets have potentially greater insight into what's going on in economic terms. And something's amiss here because bond yield spreads between the 2-year and the 30-year have narrowed to the most narrow they've been in quite some time. So obviously, longer term bonds are not seeing inflation, and that is telling us something, correct? Something perhaps the Bank of Canada isn't seeing.
Yeah, maybe. And the other thing too is we could add on that chart is that the fact that maybe these central banks like the Bank of Canada and the Fed are getting ahead of the inflation curve and they're raising up interest rates, and inflation will not resurrect, which is good for longer dated bonds like 10 and 30-year bonds, which we had talked about, 2 years ago, and we positioned ourselves for that yield curve flattening. So it's played out pretty well, and I think it may have a ways to go, with the risk being recession, which I think you may have a chart in the U.S. on that.
Yeah, we'll talk about that because here's the U.S. Here's the U.S. Yield curve as well. Not as flat as the Canadian yield curve, but still pretty close to its lows.
Mm-hmm.
And there's your chart that you were just mentioning.
Oh yeah, I think that we've talked about this chart over the past week or two, but basically what the chart shows in yellow is that U.S. 30-year minus the 2-year yield, so the 2/30s curve in the U.S. Treasury bond market, we call that the 2/30s curve, and that's in yellow. And we just saw it in the previous slide. And the blue shaded areas are U.S. recession. So when that yield curve flattens down, and you can see it goes down towards, on the left-hand scale, down towards zero, and quite often back in 89 and 2000, it was negative. It went inverted. So I think that white box in the bottom right, if we start getting down towards that level, which is still a ways away, then you're right. That bond market's probably telling us something.
And if we recall back in the beginning of the year when the U.S. were getting all excited about the new administration, the potential for tax reform, healthcare reform, and increased government spending on infrastructure and things like that, there was a fair bit of excitement about the potential for the U.S. economy, but none of that has really played out. And the fact that it hasn't played out, even if they do eventually get some kind of tax reform, the impact on the economy is going to be lagged considerably for at least a year or more. In between now and then, as we've said in the past, we certainly could see continued U.S. economic slowing, and it wouldn't surprise me if some of that came from certainly came from the residual of the hurricanes.
Yeah.
Well, we're also paying close attention to the global debt situation. Global debt is at record highs. Last week we mentioned and brought up the whole idea of margin, and just as a bit of an intro to a re-intro to the margin issues. When investors borrow to buy stocks, that's what they call using margin. And as long as the value of the stocks is higher than the debt that is owed, everybody's going to be comfortable. But if markets start to sell off, stock values start to fall, it's going to lead to increased selling to cover the margin debt. So that can actually magnify the move lower. We showed this last week, Paul, but we got margin debt at record levels, and you wanted to do some comparisons to '08 and even what was going on back in the dot-com bubble in 2000. We're even have more margin on in markets right now. So certainly,
how does that chart make you feel, being long U.S. stocks?
Yeah, I agree, and the problem being is that if you do get any kind of correction, the whole margin effect could exacerbate it significantly, correct?
Well, the other thing too is you don't even need really a correction, but don't forget that the Fed has raised short-term rates a few times here. Yep. So the cost of borrowing short-term money, which is what margin debt is, has already gone up. So it's become more expensive. So if your long position in U.S. stocks doesn't continue to really perform and provide you a better return, given the costs have gone up on your borrow, then it doesn't become as great a proposition, does it?
No. And that's something that obviously, another thing we want to monitor very closely, but does add considerable risk into the whole sphere of equity market trading.
That chart's ugly.
Yeah. And I won't go through this in detail, but, we continue to think that earnings are not representative of where stocks are on a relative basis. But we've been carrying that one for quite some time now. And of course, the geopolitical issues, as I mentioned, the Trump administration continues to struggle to move its agenda forward. Healthcare reform is all but dead, and tax reform is next, but it's going to face some hurdles along the way as well. And then, of course, we've got the North Korea situation. They've suggested that last week's UN speech by President Trump was nothing other than a declaration of war. And there was a press conference just before we came on the air where Donald Trump was basically saying that he wasn't backing down, let's put it that way. Anyway, what's going on with you as far as some of our tactical positions?
We added some positions for some newer clients. One corporate bond position for fixed income and a high yield bond, and then we added a Canadian ETF in our global equity model for some newer clients. And again, going back to that one table that we show where the Canadian stock market is underperformed this year pretty significantly on its own currency basis. We thought we'd better get some people more invested in Canada that were newer clients that didn't have quite the same weight as more existing clients. Away from that, I am just doing some more work and trying to fine tune a few things. So no big additions or reductions to any positions over the past week.
All right. Okay. Well, thanks for that. That's it for today. We want to say thank you to everybody for taking the time out of your busy schedules to tune in. I hope that you're finding the dialogue style of webinar a little bit more interesting, and we certainly love feedback on it, and certainly love to know if there's anything that you want us to focus on specifically. So please feel free to email us with your commentary. We will be back with our next update next Tuesday. So until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week and a wonderful weekend to follow.